Welcome to How to Invest. Today we're going to be talking about how to build the perfect portfolio because all of you guys I know want to be able to make a lot of long-term gains in the stock market. You want to be able to retire, you want to be able to get wealthy, and having a solid portfolio is a great way to do it. And I think that this is a really great video for our beginner series because I think for a lot of people this is overwhelming. There's like, how do I diversify and all that? And it's really not that hard. So we're going to be simplifying it for you today. I'm here with my sister, Abby. You want to say hi?
Hi, my name is Abby, as he said, and this is Investing for Beginners.
Yep, this is episode number 6. So if you haven't watched the other 5 videos, you definitely need to watch them.
Right now.
You were the beginner here that I'm teaching. So did you find the other videos helpful so far?
Yeah, I mean, obviously I've heard a bit from you as you've been helping me invest, but actually going step by step has been super helpful just to understand a little bit more of the terms, but also understand why. Why am I liking this company and disliking this one? So.
Yeah. All right. So what do you think is going to be one of the first things that I say is really important when building the perfect portfolio?
I actually don't know. I would say the thing I've heard is diversify, but I don't know if that's what you're going to say.
What does diversification mean to you?
I would just say that's probably having multiple stocks, not going all in on one thing, but having different opportunities. Because if one company fails, you still have your other companies in your portfolio to kind of not bankrupt you.
Yeah, for sure. So one thing I want to say kind of at the start of this is that I'm talking to Abby here, my sister, and teaching her, and she is quite young. So that means that she has a lot of years ahead in order to grow her portfolio, in order to compound her money in the stock market, which means that the advice that I'm going to give to her can be a lot riskier, like short-term risky, as far as volatility is not that big of a deal because I know she doesn't need the market for the money for many years. So if you're watching this and you're already in your 60s or 70s and you're a little bit older and you need the money in the next couple of years, then just know, take a little bit of what I'm going to say in this video with a bit of grain of salt, because I don't mind short-term fluctuations and I don't build my portfolios in order to avoid fluctuations. In my opinion, the perfect portfolio is one that's going to get the best returns long term. So just so you guys have a little bit of background on me, I actually forgot to do this here. I have been investing ever since I learned investing from Peter Lynch, who's one of the greatest investors of all time. He has written a lot of really great investing books. My favorite one is called One Up on Wall Street, where he literally teaches you how to invest better than the professionals. And Peter Lynch beat all the professionals, and he knew how to invest better than all the professionals. So I think he's the perfect person to learn from, right? Because he actually did it. And since learning from Peter Lynch, I have averaged over 70% annualized returns, which is really crazy to grow your portfolio, to not be able to talk and to still be able to grow your portfolio. 70% a year is crazy. And then the last 2 years, I've actually grown more than 100% a year. So that's more than doubling your portfolio every single year. Which is, really crazy. And the way that I have done this, so this is going to be my first, I like to give a really contrarian point at the beginning, although our intros are so long, but it's not really at the beginning. But the first point that I'm going to give you is don't diversify for the sake of diversification. Building a perfect portfolio and feeling like you need to buy stocks just so you have more stocks is a really bad idea. I would rather you only own one stock that you really knew super well, that you understood the full story of, that you knew was like a good valuation, you had a ton of growth ahead, you trusted the leadership, it like didn't have much risk, it was already profitable, all that. I would rather that than that you own that one stock and then put 80% of your money in 4 other stocks that you don't understand just so that you're diversified, because actually you're going to be less safe that way. Because when you invest in stuff you don't know and it drops a little bit, you're going to be scared, you're going to want to sell. And one term I love from Peter Lynch is oftentimes all you're doing is diversifying. You're diversifying, not diversifying. So I personally think the ideal portfolio size, especially for an individual investor like us, especially if you don't want to do it full time. Like I love doing it full time. I love listening to a ton of earnings calls and stuff. And even I don't like owning more than 10 stocks because I like to only have my best ideas. Warren Buffett literally talks about how if you own one or two really great companies, that's all you need to do really well in your life. Warren Buffett, he only owns one stock. Personally, all he owns is Berkshire Hathaway. Now, Berkshire Hathaway owns a bunch of different companies, and Berkshire Hathaway itself has a ton of products and a lot of different income sources. But you can own a company like that, one company that has a ton of different segments and a ton of different revenue, and it can be really safe in and of itself. Just because it's one stock doesn't mean it's not safe. So, yeah, I think owning more than 10 stocks, especially if you're only able to put a couple hours a month into your research or something, owning more than 10 stocks is probably going to be a bad idea. So, yeah, that's my first point is don't own too many stocks and don't try to own a ton of stocks just to do it. I think I loved Warren Buffett's partner, Charlie Munger. He always had the greatest takedowns of traditional education. One of the things he said is he's like, I'm a bit of a student of Alzheimer's myself. And despite that, I can't wrap my head around the Alzheimer's that's involved in, or something like that, that's involved in traditional education. It's a level of Alzheimer's even I'm not at. Those are the sorts of things that he says, because they teach you all this math and these numbers, and don't ever have more than 2 or 3% of your portfolio in a single stock. And it's especially if you're new, especially if you're dealing with a small amount of money, you're not going to grow that fast that way. You have to be concentrated into companies that are going to do really well if you really want to get good returns. Now, yeah, I'm saying that as someone who's trying to double my portfolio every year, but you have to be patient as well. Don't mess with options and all that. But okay, so designing a portfolio, staying on topic. So don't diversify just for the sake of diversification, but then also when you are owning more than one stock, try to own them in different sectors. So you want to understand what you own, but you also don't want to own a bunch of stuff that's just in one sector. Our uncle...
We talked about in our previous video, sectors are about the category. So technology or beauty, that kind of stuff.
Yeah. So our Uncle Everett, hopefully, I don't think he minds us telling the story because he's told us a bunch of times. He owned a handful of different stocks at one point, and he thought he was diversified because he owned, a bunch of different stocks. And he was in real estate. I'm telling them, he's in construction. He's been in construction his whole life. And when there was the really big market crash, he lost all of his money in the stock market because all the companies he owned, even though he owned a lot of them, they were all in home building. So when home building dried up and home prices crashed, they all went out of business because they were all exposed to the exact same risks. So it was a little bit of diversification. Sure, if one of them had fraud or something, the other ones wouldn't have been affected. But in an economic turn down, if he had a home builder, which he really understood, and maybe he also understood insurance because he was selling homes or something, and understood that people needed insurance. Maybe he had to deal with insurance companies. He could understand more than one sector.
Yeah.
Or maybe he really liked energy drinks, and he knew this one energy drink was doing really well. So if he owned a home builder, an insurance company, and an energy drink company, he might own way less companies. Maybe he had 30 home builders. He might only own 3 companies and think he's less diversified. But because they're in 3 different sectors, he's way more safe. He's way more safe. Because in a housing market crash, it's energy drink sales might drop a little bit in a super bad economy, but it's not going to completely dry up. Or insurance. It's literally illegal not to have car insurance. Or if you have a mortgage, it's illegal not to have a home insurance. So people can't drop their insurance in a bad economy. Mm-hmm. So having companies in different sectors gives you real diversification. So yeah, if you have a really good, if you're investing in Tesla, for example, probably don't look for another EV startup and then think you're invested because you own Tesla and Rivian. It's like, okay, they both are in the auto sector. They're both going to probably do really well when interest rates are low and the economy's booming. They're both going to do really bad when interest rates are high and the economy's struggling. So that's not diversification. And even though you really like EVs, it doesn't count. Does that make sense?
Yeah, no, that makes sense. It's kind of putting all your eggs in one basket versus spreading your eggs out between 10 baskets.
Yeah, exactly. Okay, so then the last thing that I want to talk about here, so we talked about how it's good to own more than one stock. Like I would recommend like 2 to 10 stocks. Just because if you have more than one stock, if one company goes up a ton and like has all this positive press and stuff, you can move money when it gets a bit more overvalued into your other company that you really like that's not as overvalued, and you don't have to sell out of the market. You can stay invested and just move the money back and forth for when something's super undervalued, maybe you move a bit more money into it. But if you only own one stock and it's down a ton, you can't do anything. You have no other money in the market to move into it. Or if something is up a ton, you might be like, I just don't have any other, even though it's expensive, I don't have anything else I can buy. So having at least 2 stocks gives you a lot more ability to actually manage your portfolio and take advantage of mispricing when you own 2 different stocks in 2 different industries. Okay, so we should mention just for a second before we end here, bonds. So this is a stock market investing portfolio. I don't own any bonds and I don't recommend it. In fact, Peter Lynch has a ton of really great research in his book that just shows that bonds just don't perform as well as stocks. So the difference is owning a stock, you actually own a company. You actually have ownership in the company. When they earn more, they're going to raise their dividend and pay you more. Owning a bond is you just have debt in a company. And if a company earns more, they're not going to pay more to their debtors than they owe, to their lenders than they owe. So you have way less upside. You don't have as much upside in the economy. And then normally you're just getting 5, 6, 7% max as your interest on the debt. Whereas the economy and many sectors are growing much faster than that. So many companies are growing much faster than that. And just over the long period, bonds have never performed as well as stocks.
So it's not that they don't perform at all. It's just if you're looking for the best way to kind of get returns, bonds are not the way to go.
Yeah. Now, if you're, like I said at the beginning of this video, if you're much older and you need steady income, owning the government debt can be really safe. Because they're going to pay that money back because they can literally print money. So they're going to pay your initial investment back and you can get your 4% or whatever your yield is. And, maybe if you're living off of that money and you have $2 million, your 4% is $80,000 a year and that's all you need and you don't want the money to go down at all. You don't want any risk of the money going down. That could be a good way to do it. But just know you're purposely going to be underperforming what you could be performing. Which is why for someone like you, Abby, I would recommend you have all your money in stocks, probably for many, many years, many, many decades. So that is our quick video on building the perfect portfolio. If you want to know how to build a story for which stocks you should put in your portfolio, you should watch our second video in this series on how to know what stocks to buy. If you want to know what sort of psychology you need, watch these other videos in this series.
They're actually super informative and they help me understand better.
Yeah, they're really, really good. And then if you want to go even more in depth and want a dedicated course, we're building a whole 0 to 100 in-depth course that's really going to make you an expert investor that we would highly recommend. It's not done yet, but it will be linked in the description when it is finished, and you can go through that course. Or you can just watch more of our videos as well as a great way to learn. It's not going to be quite as organized and set up to make sure you don't have any gaps and all of that. But you'll still learn a lot watching more videos. So make sure you're subscribing and hitting the thumbs up button. And you want to say a final bye to them?
Bye!
Bye.